Facts.
Hey gang, I'm Dr. Who. This is Accounting is a Joke, where accounting makes sense so you can make dollars. Today we're going to take a look at a walkthrough problem on how to properly journalize the adjusted entries from the unadjusted trial balance and post to the ledger. So if you're unfamiliar to adjusted entries, don't fret gang. I dropped a link to a video to get you up to speed in no time. So with that being said, let's get it. So it tells us the unadjusted trial balance of all mopped up company cleaning services as follows. Let's see what this trial balance is looking like. Okay, so we have an unadjusted trial balance. And then it says during the 12 months ended December 31st, all mopped up, had the following transactions. Okay, we have 5 adjusted transactions. All right, it tells us first to journalize the adjusted entry using the letter and December 31st date for the column. Okay, so before we go into this game, I wanted to share a few tips with you. In terms of these 5 particular adjusted entry transactions, we know that we have certain accounts that will be adjusted. However, based on the information that's given within the transaction, it will provide either the amount to adjust by or the proper ending balance that we have to calculate the adjusted amount. You see the difference? So in other words, they could give us the number in the transaction that we're going to use in the journal entry, or they could give us the number in the transaction that we're going to use as an ending balance to calculate the adjustment. And so we have to be very careful and critical about the words that will refer to making the adjusted amount or giving us the ending balance. So the very first one tells us use office supplies of $1,700. What are the key words? Obviously used and office supplies. Now, based on that keyword used, gang, it is easily identifying that we used up a certain amount of supplies. Now, we know we adjust supplies every time we use them up. Therefore, the keyword used is telling us that the $1,700 will be the amount we're going to adjust by. Okay? So we know how to adjust supplies. We debit supplies expense and credit supplies. And we will use that adjusted amount. It's the record office supplies used. We're going to check the answer. Well done, gang. Moving on. Use prepaid insurance of $580. Well, what are the key words? Use and prepaid insurance. This is an easy one, gang, because it's just like alphabet A, right? We already know how to adjust prepaids. We always debit the expense and we credit the prepaid. But we also know that supplies is treated like a prepaid, so it's going to be a similar transaction as the previous example.
Yup.
But let's look at the key words. Used. Again, the word used describes the amount that we have to adjust by, because that's the amount of the asset that has been used throughout time. So we're going to easily plug that $580 in there, and we know we're going to debit insurance expense and credit prepaid insurance. We're going to check the answer. Well done, gang. Next, we have some depreciation equipment of $500. This is the easiest, in my opinion, of the adjusted interest, because anytime you see that word depreciation, you depreciate. And we already know we're going to debit depreciation expense, credit accumulated depreciation. Cakewalk. Check the answer. Nice work, gang. Next, we have accrued salaries expense of $310 that hasn't been paid yet. What are the key words? Really, all we need is accrued salary expense. Why? Because we know by definition accrued expenses are expenses that happen, but they haven't been paid. And we know how to record that as well. We always debit the expense and credit a payable. So, in this particular transaction, we're going to debit salary expense and credit a payable for the amount given. Check the answer. Good job, gang. And last but not least, earned $400 of unearned revenue. So let's take some time to identify the key words. Earned and unearned revenue. So what do we know about unearned revenues, gang? It's a liability. And how do we create that liability? The company has to receive cash in advance for a service to be provided in the future. So when it's time to provide that service, that initial liability must go down. And why is that liability going down? Because we are generating revenue. If If we're generating revenue, it must be recorded. Therefore, the proper adjusted entry for unearned revenues is a debit to the unearned revenue, lowering the liability, and a credit to the revenue, earning the true revenue that's been earned. So, key word in here, gang, was earned. That is the adjusted amount that's needed to be put in the particular transaction. How do we know? Because as we earn true revenue, that initial liability must go down. So since we've earned 400, that is the amount that must be posted. Check the answer. Nice work, gang. So now the easy part. We're going to transfer all of those particular journal entries that was made into the journal and post them correctly into the ledger. And so if you've been watching previous video games, you should already understand how to properly post. If not, I'm going to drop a link in here so you can get up to speed in no time. But I'm going to fill out these T accounts based on our previous journal entries just to save time. Okay, so let's do a quick recap of the proper posting. As we already know, gang, we only adjusted certain accounts. The other accounts that wasn't affected is going to keep the same initial balance. So we're not going to focus on those such as cash because cash doesn't have an adjustment. I'm just going to review the adjusted amount ones. So we saw that service revenue, we had to credit it for $400, thus had to increase the balance. Remember, we had to accrue revenue. We also saw with supplies, we had some supplies that was used. So of course we have to credit supplies for the $1,700, which will give us a new balance. We had some accrued salaries as well, which made us have to increase our liability of $310. Obviously, that same accrued salaries also encouraged us to increase the salaries expense of $310. So we have a new balance. We had some prepaid insurance that was used. So we have to credit our prepaid insurance by $580. We also had some unearned revenue that was earned, which means we had to debit the unearned revenue for $400. We already said our supplies expense was accrued. That's why we have a debit to supplies expense for $1,700. And we had some depreciation we had to account for. So we had to debit depreciation expense for $500 and credit accumulated depreciation for $500 as well. And last but not least, we had some insurance. And last but not least, we had to adjust our insurance expense amount because some prepaid insurance had been used by $580. We're going to check the answer. Fantastic. So there you have it, gang. A quick, easy illustration of how to properly adjust the transactions based on the unadjusted trial balance as well as post to the ledger. So if that light bulb clicking it brought you further to chasing the bag with this accounting information, please smash the like button, share with your friends, and subscribe to the channel so you can chase that bag even more. As always, I'm Dr. Who, and I love the time that you share with me, gang. And I wish you well, and see you soon. Bags!